Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a bright, early Monday morning. We are coming to you live, as always, from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Morning, guys.
Hi, good morning. Morning, Nigel. Start of a brand new week and a lot of cues to track this week. Looks like we're going to start with a bit of a back foot this morning, but we'll take it as it comes.
Looks like it. I mean, the market has been in a range, right, for the last 4 or 5 days. It's not done very much at all. So it's been, what, a 100-point range on the index for the last 4 sessions now. The lower end broadly has been about 18,200. The upper end has been about 18,300. I mean, of course, there was an overshoot as well middle of last week, but that's been the 100-point broad range. So it's not done very much. Now, we're actually starting with a lot of news flow from elections in Turkey, Thailand, but not really relevant for us. But there was relevant news flow in terms of inflation numbers out of India, which I think is significant. So inflation, headline inflation at least, is below 5% for the first time in 17 months. This is important because there was a lot of debate after, RBI's action or lack of action last time about what happens, in subsequent meetings. And if anything, this number kind of reinforces expectations that, the pause was correct and perhaps the pause will be extended as well. So this is something which we will come back to, but I think it's unambiguously positive from an equity market standpoint as well. The other thing, of course, was the Karnataka state elections where, it was a sweep by the Congress. The BJP is out. The state, of course, has not returned an incumbent back to power in the last almost 4 decades or so. So it's a rotation. But the margin of victory which we've seen, the number of seats which have gone to the Congress, I think it will sharpen the focus on politics generally. And, of course, other state elections leading up to the big elections in 2024. I don't think there's any very immediate kind of outcome, but this is something which will be at the back of the market's mind that, there can be upsets and one should be open and accepting of those as well. Now, global cues that we will react to are largely soft. The Nasdaq was down about 1/3%. The S&P 500 was down about less than 1/4% or so. You had the University of Michigan Inflation Expectation Survey, which basically showed that expectations are stubbornly high. As a consequence of that, we had yields which actually were steady. But the dollar index is something I want to highlight. The dollar index is looking, technically speaking, it's broken above its double bottom neckline at 102.4. And it could, technically, if you kind of project targets, we're looking at 103.5, 104 kind of levels. So the dollar index, based on this pattern, looks like perhaps it's at the cusp of some sort of a reversal. We'll come back to this as well. But this is not good news. You want the dollar weaker, not very strong. Now, let's come to the levels here in India. The Nifty, because, we've been in this tight 100-point range. The levels don't change very much. The support stands at 18,250. It's moved up a little bit because this is the lower end of what is a rising channel. So 18,250 is the first support. And then you've got the Friday before last's low, which was 18,055. So these are the two broad numbers that you want to keep, as supports, as areas around where you want to poke in and try and buy the dip for a trade, if you are trading. On the upside, the level is the 78.6% retracement of the entire fall. That has not changed in the last 2 weeks because the market's not gone there. 18,450 is that level if the market starts to make a bit of a move higher. Now, the Bank Nifty has broken above the high of 43,740. We were talking about this intermarket divergence where the Nifty was making a higher high, the Bank Nifty was lagging, but the Bank Nifty on Friday did break above that high. On the way up, I think there is only the all-time high, which is at 44,141. That would be the logical kind of target. And supports for the Bank Nifty would come in at the 20-day moving average, which stands at about 42,883. So that's basically the broad kind of picture which we are starting another day with. The SGX is indicating a 50-point downtick. An hour back, it was about 65 points. It's improved a little bit, and maybe it does a little bit more as we get closer to the open at 9:15. Sonia.
Absolutely. And I think this 18,300 level has been a bit of a sticky zone for the market, right? We took that out last week, but this week looks like Staying above that could be a bit tricky, at least at the start of trade. The SGX Nifty indicating that the start will be mildly in the red. A couple of things to remember. This has been a very strong market, no two ways about that. And the Nifty is now, about 3% away from those all-time highs of 18,887. So the trend is on the upside. It's just that we are facing a bit of resistance at the upper end of the trading range. The FI flows continue to come in thick and fast. There was a big buy figure that came in on Friday as well. And put together in the month of May, it's almost 13,500 crores of buying that we've seen. So the buy on dips is something that can continue. Let's see if this dip comes through as the SGX is suggesting. A lot of rate sensitives, banks, autos were in focus last week. And in that context, perhaps those dips could be bought. Talking about autos, very strong earnings from Tata Motors, and this entire pocket has been, the big mover in all of last week and the month. More important than, of course, JLR numbers have been very strong, but the debt has gone down considerably. The auto debt is now at a 15-year low for Tata Motors, and that's something that the street will take with both hands. So I'm focusing on that. Even the CV business has been really strong for Tata Motors. In fact, all rate sensitives, now that perhaps we're entering a rate cutting cycle, we could be entering it anytime soon. Autos, banks and real estate has been in focus, and in that context, very good numbers coming through from DLF as well. Bookings at a record high, collections at a record high, and the new luxury project has done exceptionally well for DLF. So these are a couple of pockets that I'll watch, the rate sensitives. A lot of results this week too. You have Bharti Airtel that comes out with results tomorrow. There's Bank of Baroda. There's ITC, Bata, Indigo, Zomato. So a lot of non-index large caps coming out with their numbers as well. So it's an action-packed week in that sense. But just purely for today, for the start, we may start off on a bit of a back foot. But, this market has used every dip as a buying opportunity. So I won't be surprised if that happens today as well.
Well, I'll tell you what, Sonia, that dip that you're seeing on the SGX 50, the bulls would have liked a bigger dip. So let's see whether or not that comes, because it gives you an entry opportunity. So the buy on dips thesis is going to be tested today. But provided that 18,100 odd level holds out. I'm not going down to the 20 DMA, which is around that 18,000 odd mark, but 18,100 will be the first support zone. Nifty Bank has been in a world of its own. That's been moving from strength to strength, less than 1% away from 52-week high. So that's going to be the driving factor. That needs to continue. And also going by the data points we got, both on the inflation coming at multi-month lows, as well as the weaker IIP data, well, now the streets could start factoring in a rather dovish RBI, because hikes could be off the table. And I was reading a couple of articles on the Bloomberg yesterday. They're also talking about possibly an outside chance of a CRR cut as soon as the June meeting. So let's see whether or not that happens. So short point is the street could start factoring in a more dovish RBI from here on. The flows, they continue to remain positive, but the net institutional numbers, well, they're a tenth of what we have seen on an average in the last 10 days. So yes, the FIs continue to buy, but I'd like to look at the FI and the DI number together. So that's a little bit disappointing, but let's see if it was a one-off and things recover from here. The FIs, they remain net short on the index, and I like that. You want to see those short positions built up, because that could be a bit of a fillip on the upside, in case they get stuck on the wrong side. So 54% of their positions on the short side, 15,000 contracts in absolute terms. And there was some writing that we saw even in Friday's trading session. The 18,200, 18,000 puts, both of them fairly active, adding close to around 60 lakh shares between them. The problem for the Nifty is it's going to face resistance at around that 18,380 to around 18,400, because we went there last week, and from there we did see some selling. So let's get straight to the levels. 18,100, 18,150 going by the options data. That's a bit of a support zone. On the upside, the bears are positioned to hold on to that mark. For the Nifty Bank, well, it could pull back close to 100%, but you'll have to say risk reward could favor you. At around that 43,300 odd, that should be a bit of a stop loss. The SGX Nifty is suggesting a bit of a downtick. Buy on dips is likely to continue. 18,100 should be a crucial support on the Nifty itself. So let's see how this one goes.
All right. Well, SGX indicating a 50-odd point lower start as we begin another trading session, another Monday. Well, before we go any further, let's quickly tell you what's lined up here in the first half hour of the show. We get you updates from markets around the globe. Rupal Agarwal is our guest in the program. She's, of course, with Bernstein. She tells us what she's making of the global setup, implications for India. Our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At 8:30, we'll talk stocks and results with Prakash Devan, who's our guest.
All right, let's also kickstart the show with some equity views coming through. How do you approach the week? On the equities front, Sanjeev Prasad of Kotak Institutional Equities says Congress's resounding victory in Karnataka Assembly elections may not mean much for the likely outcome of 2024 elections, given continued high popularity of Prime Minister Modi and the trend of BJP outperforming in national elections versus state elections. He adds the market has recently found support from an improved macro outlook and low-quality earnings beat in Q4 results season, but has largely ignored a weak macro outlook and growing disruption risks, which may weigh on rich multiples of growth stocks.
On the rupee, B. Prasanna of ICICI Bank says the dollar strengthening on safe haven buying as worries related to debt ceiling triggered risk off. The rupee depreciated mildly with the resurgence of dollar while outperforming its peers, even as RBI is active in recouping dollar reserves. According to Prasanna, the INR is supported by FPI inflows, lower crude prices and domestic macros in the near term. He expects the rupee to trade in the 81.7 to 82.5 to a dollar range this week.
And on the bonds, B. Prasanna of ICICI Bank says that the risk-off centimeter and softer inflation data kept global bonds biddish last week before witnessing a marginal reversal later in the week. Local bonds continue to trade benign, even amidst regular weekly supply, given expectations of lower domestic inflation. He expects the markets to trade sideways, with the Indian 10-year benchmark yield ranging between 6.95 to 7.1 due to softer inflation print balancing out the higher global bond yields.
Well, over the weekend, we have got a lot of action that we have seen. So let's get straight to the stock-specific action. We're going to be tracking that for you in just a bit in our special Top 10 segment. We're looking at Tata Motors, Colgate, HPCL, Manappuram Finance, DLF and Navin Fluorine. They are stocks on the back of positive news flow. On the flip side, you have Avenue Supermarts, IGL, Max Financial and APL Apollo Tubes that could open up in the red.
All right, well, let's welcome in Rupal Agarwal, Senior Research Analyst, Asia Quantitative Strategy at Bernstein. She's joining us right now to take some questions. Rupal, good morning. Good to have you with us here. Thank you for your time. So, you know, what's the quant picture telling you about where markets are headed, global markets broadly, Rupal? What's the perspective?
Sure. So I think from our perspective, you know, when we started of the year, at least on Asia, we were quite bullish, and we still maintain a bullish view on Asia over the 12-month period. But in the short term, we do think that risk of a global recession has increased since the beginning of the year. And hence, you know, we are still taking more of a balanced approach across the region, including, you know, even for a market like China, where we do think that we are very close to a market bottom. So I think China probably is one area where we are very closely watching, that we are heading more towards a bottom. But most of the other Asian markets, at least, we are still taking a much more balanced approach.
Okay, so you're saying that the risks of a global recession have increased since the beginning of the year, but in terms of individual, markets, there's a bottom formation perhaps in China. Any other emerging markets that look like, there could be at the bottom and there is a longer structural upcycle, perhaps for the next 12 to 18 months?
I think a lot of that bottom formation, in our view, happened back in October, and that is the reason we saw this significant risk-on rally across Asian markets, in the month of November, December, and January. A lot of that has moderated, I would say. And so most of the Asian markets are well positioned from a 12-month perspective, but in the shorter term, we do see some risk building because of, as I said, the global recession and the fact that a lot of Asian markets are moving much more closely to the US equities than it typically tends to be, except for, of course, China. So I would say China stands out as one of the key markets in focus for us. Rest of all the other Asian markets positively positioned for the next 12 months. We are slightly worried in the shorter term.
All right. Morning, Rupal. Always good to hear your thoughts and good to see you in. Rupal, so it's China outweighing India at this perspective, right? Primarily because of valuation concern. Would that be the case? And also I wanted to ask you, since most of the commentary that we get is factoring in a rate cut towards the end of this year from the Fed. Are you in that camp?
Okay, so firstly, on China versus India, I would say when we started of the year, we were much more positive on China, much bearish on India. Our bearish view on India has slightly come down because of valuations coming back to 10-year average levels. And, the disconnect that we were seeing between market valuations and the 10-year bond yields in India, that has completely normalized. Having said that, I think the way that investors have been positioning across China and India is very different. And that actually sets up a very interesting, market environment. So for China, what we are seeing is that there's been a lot more hiding in safe haven assets and defensive, trades in the market. Because of that, something like, say, a low beta trade is actually trading at, it's the most crowded that we've seen that trade in the last 10 years. Versus if we look at on the India side, it's completely the opposite. High beta has been doing very well since COVID bottom, and it continues to trade at all-time highs. And in fact, it is, the most crowded. So it's a complete opposite setup that we are seeing from a pure quant perspective. One would ideally want, high beta to start looking much more attractive for us to become more convinced that we are heading towards a more sustainable risk-on rally. That is something that we are now seeing in China, but not necessarily in India. So it's not completely a valuation-driven call. It's also driven by, how investors have been positioning. And this significant trade that we've seen in the last 2 to 3 years build up in each of the markets.
Just one follow-up there. So, from a quant perspective, how are you looking at rate sensitives now? Because in a market like India, on the hope perhaps that there will be a rate cutting cycle anytime soon, a lot of the rate sensitives, banks, autos, real estate has started to pick up. How are you looking at these pockets?
So yes, so we have been positioning in some of the rate sensitive areas. We still like some of them, but the way that we always look at it is approaching it more from the angle of being still more defensively aligned. So yes, we will still be comfortable owning, say, some big financials, but only the ones which are giving you very low volatility. Similarly, on the auto side, we will be comfortable owning the ones which are giving you high yield, which is essentially a defensive value trade. So that's how, we are still approaching the market. Because if you look at, interestingly in India, since the beginning of the year, I would say it's become actually an even better stock pickers market. The dispersion across the market is very high. The correlation within the stocks is very low, which is great time for active stock picking. And in that context, what we say is that, the key support that we are getting across the market is essentially from defensive pockets, which is essentially either you look at high quality names, or you look at high yielding names, or you look at companies that are giving you low beta. They are actually trading at almost all-time high discount to the market, almost one standard deviation below the levels that we've historically seen. So valuation-wise, very comfortable. Even from an earnings standpoint, we are seeing these names being net upgraded relative to the market. So I think that's the kind of stocks or sectors that we are more focused on. So I would say from a sector standpoint, it would translate into reasonable exposure towards staples, healthcare, technology, and only select banks, the bigger ones in financials. It's largely a negative discretionary industrials trade.
Okay. All right. Rupal, we'll leave it there. It's always a good conversation. Thank you very much for joining us with that perspective. Rupal Agarwal, a Senior Research Analyst, Asia Quantitative Strategy at Bernstein. Well, we'll take our first quick commercial break. Our list of top stocks to watch with our research team coming up in just a bit. Stay with us.
Back here, tuned into Bazaar Morning Call. Hope you're having a good morning. Well, as promised, let's get straight to the stock-specific action. Our entire research team is standing by to help you out with just that. Sonia, you go first. Tata Motors, numbers good?
Well, good set of numbers, largely above what the street was estimating, and strong, growth across businesses for Tata Motors. I'll come to that in a bit, but more importantly, I think what the street will focus on is how the balance sheet of Tata Motors is improving. So the net auto debt for Tata Motors has gone down by 13,800 crores compared to last quarter. And that's a big fall in their net debt. It's something that the street likes. Also, the CV business EBITDA margin has come in at a 17-quarter high of 10.2%. Overall, if you look at it, the management is now targeting more than a 6% EBIT margin in FY24, and the India business net debt is now the lowest that we've seen in the last 15 years. Quickly to run you through how the overall performance has been very strong. So revenue growth of almost 34%, EBITDA has gone up 58%. The poll was 13,900 crores EBITDA. It's come in at 13,100 crores. So in that context, you could say it's slightly lower than what the poll was indicating, but very strong numbers nevertheless. Even the net profit number at 5,400 crores is much higher than the poll of 4,680 crores. But the Jaguar Land Rover business is improving quite considerably, and that's something that the street will like. 50% revenue growth, EBITDA margin up 200 basis points year on year, volume growth of 24%, realizations are up about 20%, and it's an adjusted profit that JLR has reported this time around. Also, the street is quite confident that, the guidance that JLR has put out to deliver a $2 billion pound free cash flow in FY24 is something that they can achieve, because it's a strong free cash flow of 16,600 crores in the second half, and the full year auto free cash flow has come in positive at 7,800 crores. So that's something that the street will definitely like. But let's not forget that the stock has also rallied considerably in the last many weeks.
Okay, all right. Thanks a lot for that, Sonia. Well, let's hop across to Mangalam. He's tracking a whole host of results, namely Colgate as well as DMart. Morning, Mangalam. DMart's numbers a little bit disappointing.
That's correct. So let's start with DMart itself. Well, the revenues of the company are largely in line with expectations, and that's because the company had already given the revenue number in its fourth quarter update. It's the EBITDA growth that's lagged the revenue growth, and as a result of which the gross margins as well as the EBITDA margins have been way below street expectations. Gross margins actually, despite a 20% plus jump in the company's revenue, have declined by about 100 basis points, and as a result of which the revenues, which were close to around 10,600 crores, yielded an EBITDA of just 772 crores, much below street expectations of 1,000 crores, and the net profit coming in at 460 crores, again, way below street expectations of 650 crores itself. Among the internal details that the company reported, the same-store sales growth in the second half of FY23 have been around 11%. But, FMCG continues to do well, whereas general merchandise and apparel, which is a higher gross margin business, continues to struggle. In fact, this number as a proportion of sales pre-pandemic was around 27%. That's now settled at 23%. And sales per square feet also just below pre-pandemic levels. So as a result of which, expect further red on DMart. Remember, the stock has corrected a good 30-35% from the highs as well. For Colgate, the revenues have been in line with expectations, but the operational performance has been much above expectations. And that's largely because the company scaled back on ad spend. So if you just take a look at it, revenue at 1,350 crores, the street was working with a number of a similar nature. The EBITDA came in at 450 crores, whereas most of the street were working with a number of around 400 odd crores. As a result of which, the net profit has come in at 316 crores versus expectations of 276 crores itself. The gross margins have been maintained. The company says that going forward, they believe that the category growth could be a little higher. So let's see whether this stock holds in the green in today's trading session or not.
All right, Mangalam, thanks very much for that. And for those names, we'll keep a track. Now, IGL reported numbers, and so did HPCL, and Sonal has got both of them for us. Sonal, morning.
Good morning, Prashant. Let me start with IGL, where numbers, yes, they did improve on a quarter-on-quarter basis operationally, but they were lower than what the street was working with, especially in the light of MGL and Gujarat Gas reporting a strong beat. So revenues, they were flat on a quarter-on-quarter basis. EBITDA was up 9%. Margins came in at 12.6%, but they were lower than the poll of 13.8%. Profits were also up 19%, but they were slightly lower than CNBC-TV18 poll of 365 crore rupees. EBITDA per unit in line, volumes in line with estimates at 8.3 MMSCMD. But since EBITDA was a miss, Jefferies, they have gone ahead and they've lowered FY24 EBITDA by 12% on the earnings miss. They have a buy rating on the stock with 560 rupees per share as the target price. But compared to the peers, it reported a miss, so expect the stock to be in the red today. HPCL, on the other hand, reported good set of numbers. It was a sequential increase and better than what the street was working with as well. Revenues were down 1.5%. EBITDA, however, was up 241%. Margins higher by 300 basis points, and profits, they were higher to the tune of 3,222 crore rupees. GRM set $14.1 versus an estimate of $10 per barrel, so it was a refining-led beat this time. They've also announced demerger of their lubricants business. They want to do some value unlocking. Motilal Oswal says, however, that Singapore GRMs now have come down substantially from the peak, and going forward, refining margins could see some pressure. So yes, these are backdated numbers. Going forward, we'll have to watch out for marketing margins and refining margins as well.
Okay, all right. Thanks a lot for that, Sonal. Well, Abhishek joins us to tell us about Manappuram Finance. Morning, Abhishek.
Morning, Nigel. So the results have beaten our poll. However, they are losing the sheen on the gold portfolio. So the gold loan share of the AUM is right now at 55.7% when compared to 66.65% in the same quarter last year, and about 58.4% on a sequential basis. Even the gold tonnage that they have is the second lowest in last 4 to 5 years or even more. more. So AUM growth is at 17.2% YOY and about 11.2% sequentially. Sequentially, the calculation shows that the net interest margin has declined quarter on quarter. NII is at 1,183 crore. We were working with a number of 1,075 crore, and the PAT is at 415 crore. We are working with a number of 394 crore. So it's a beat on our poll. And Asirvad microfinance that they have, their subsidiary, that gross NPA ratio over there has improved drastically to about 2.8% when compared to 6.7% in the previous quarter. There's also another update that has come in. The VP Nandakumar has received an interim stay order from the Honorable High Court of Kerala. This is for 2 weeks beginning 12th of May. The order directs him to take prior approval of the ED before dealing in his movable properties. So the company has also stated that Nandakumar will appeal against this High Court order for the modification of conditions that is there on the stay order. Back to you.
Okay, thanks a lot for that. One of the other stocks that could be in focus this morning is DLF after very strong operational numbers. Sonal has more on that. Sonal's also tracking Naveen Fluorine this morning. Sonal, over to you.
Good morning, Sonia. Strong set of numbers from both the companies. Let me start with DLF. Stellar set of bookings. This is because of their luxury projects in NCR. So look at this bookings trend. This time around at 8,458 crore rupees, which compares with the quarterly average of around 2,500 to 2,700 crore rupees. It is a record high number for the company, and 90% of this contribution came in from newer projects and the luxury projects, especially the Arbor for the company. Collections again at a record high at 1929 crore rupees. Net debt for the company is at a multi-year low in the residential business at 721 crore rupees versus 2100 crore rupees on a quarter-on-quarter basis. CLSA says that the company has given a pre-sale guidance of around 11,000 to 12,000 crore rupees for FY24, which is quite conservative considering that they have already done 15,000 crore rupees in FY23. They raised their pre-sale estimates by 21% and 14% for the next 2 financial years. JP Morgan has gone ahead, raised the target price to 510 rupees per share. The residential business is now almost debt-free, which is the first in 15 years according to JPM. Expecting green here, and also Naveen Fluorine, which was another strong set, a top-down beat here. Revenue growth of 70%, EBITDA growth of 114%, margins expanded by 600 basis points, leading to a profit growth of 81%. And all the 3 segments where the company has done well: specialty, HPP and CDMO, where revenues are up anywhere between 28 to 106%. Jeffries, on the back of this, has upgraded the stock to a buy. Target price has been raised to 5,610 rupees per share, and also raised their profits estimates on Naveen Fluorine on the back of a strong set of numbers. Expect that to be in the green as well.
All right, Sonal, thanks very much for that. Now, Max Financial also reported numbers, and the VNB margins, there is a bit of a dip as compared to the same period last year. Surabhi's got more details. Surabhi, morning.
Thanks so much for that. So Max Financials reported a mixed set of numbers. It reported an APE growth of 38% on a year-on-year basis, but that was largely expected due to higher share of non-par savings products, and also the number was factored in because the March business data was out. The value of new business, that was up 31% on a year-on-year basis, but the VNB margins were slightly lower. It came in at 30.3% versus 31.9% same time last year. So that's a point of concern. Also, the embedded value saw a good growth. It was up 14.7% on a year-on-year basis, and the return on embedded value came in at 22% versus 20%, so a 200 basis points expansion over there. Now, what's important to watch is the outlook for FY24, so kind of APE growth guidance they give for FY24, any clarity on the promoters' stake pledge, and the growth visibility in their Axis Bank channel. So these are important factors to watch out for in Max Financials.
We'll keep an eye out on that, Surabhi. Thanks a lot for that. Well, let's wind this down with APL Apollo Tubes. Then the numbers, no worries really on that front, because we already had the volume numbers. But when the volumes go up by around 18%, you'll expect some operating leverage to play out. So maybe some on the street were expecting the EBITDA per ton to be a little bit higher than what they delivered. It's good, but maybe some bit of an improvement is what the street would have been anticipating. The value-added products, well, that came down on a year-on-year basis, so that could be one of the reasons why, in fact, we did see some bit of not a great expansion on the EBITDA per ton. Net debt stays in very, very controllable levels at around 240 crores odd, and the working capital days from double digits of the last few years, it's come down to just around 5 days. The management has said that in the coming time, the EBITDA per ton will scale at around 5,000 rupees per ton, and they're looking at volumes of around 3 million tons odd. Only problem is maybe in fact valuations at around 50 times trailing are a little bit expensive. So going with the tinge of red on this one. No big disappointment, but maybe some bit of red.
All right, thanks a lot for that, Nigel, and to our entire team. Here's a quick recap in case you missed out on any of the stocks. Stocks with positive news flow with Tata Motors, Colgate, HPCL, Manappuram Finance, DLF and Naveen Fluorine. While stocks with negative news flow, there's Avenue Supermarts, IGL, Max Financial and APL Apollo Tubes. But let's also find out what's happening in the world of commodities. Manisha Gupta is joining in now for a roundup of all the action that's taken place over there overnight. Manisha, hi, good morning.
Morning, Sonia. Thank you for that. Well, I'm looking at the US dollar index, which has seen a decline of 1.5% in the previous week, and that has been the biggest weekly, gain, since the month of Feb. So the strength in US dollar, it seems to be weighing on various other commodities. There is uncertainty on US debt ceiling, monetary policy, and then there are so many US Fed speeches in this week as well. Jerome Powell speaks on Friday, so this week is expected to be quite choppy. The crude oil prices, in the meanwhile, have continued to slip, and we have seen prices decline 14% in past 4 weeks. Gold prices also have extended downward trend. We did see an all-time high of 2,080, but it's not able to hold 2,020 as well at this point in time. Same is the case with metals also. They have slipped further. So nickel is at a 7-month lows, copper at around 4-week lows. Iron ore and steel prices have continued to decline as well in Asia right now.
All right, Manisha, thank you very much for that. Now, let's come to the big story in that sense. Macros and markets, important for both. Inflation numbers for the month of April here in India has dropped to a 19-month low of 4.7%. The industrial output index, IIP, for March, though, has come off to 1.1%. The poll was almost at about 4% or so. Does this remove any fears of any further rate hikes from the RBI? Lata is here in the studios with her editor's take. Lata, good morning.
Yes, absolutely. The April inflation is a very positive number for MPC, Reserve Bank, for the economy itself, 4.7. Our poll was 4.8. There were a lot of 4.9s also on the street. So this is much lower than what, or reasonably lower than what the street had factored in. Plus, the food inflation worry is gone. If you remember, there were fears that unseasonal rains and the problems in February in terms of weather could have destroyed the wheat crop a bit. It looks like procurement is very good because cereal prices month on month have fallen. April is lower than March, and therefore there is a definite expectation that inflation will come lower than even the Reserve Bank's April, May, June forecast, which stands at 5.1. With 4.7 in April, looks like even this forecast could be surprised to the downside, and therefore the expectations that RBI, which announced the pause on April 8th, the previous policy, that pauses for good. There is no reason why it will revisit or another hike will come. But actually, the Reserve Bank's worry for inflation could turn out, could be replaced by a worry on growth if you look at the IIP shocker. Comes down to 1.1, and 1.1 is bad because there were several actually 5% on the street. It was this one-off numbers which made our average to 4% on the poll. But 1.1 is quite a shocker. And if you look at the April-February average, it is 5.6. And terrible performance in power, minus 1.6. Consumer durables, minus 8.4. Consumer non-durables, minus 3.1. I mean, this is a contraction from year-ago levels. And if electricity also drops, the fear is that even industry probably consumed less, other than consumers as well. So this is going to be a fear. Impact on the market now. I think on Friday, when we closed below the 7% mark, this poor CPI or this low CPI number was already in the price. We have to be a little aware of why the yields are falling. It was the extraordinary buying by insurance companies because of the tax change after March 31st that led to a lot of collections. We saw it in all the insurance companies. That's why there's so much of bond buying. And of course, HDFC Bank buying ahead of the merger. It is unlikely that this will continue. To factor in because of this CPI number or because of the yield falling, that there will be a CRR cut or a repo cut should be simply out of the market's mind. The RBI doesn't hint that at all. And I'm telling you why. CRR is a liquidity tool. If you cut it, there will be more liquidity in the banking system. The amount, the FX reserves have gone up by $7 billion in the previous week, ended May 8th. that number we got on Friday. You know, what is $7.1 billion? It is over 56,000 crores that has come in by way of liquidity. And in the week just ended, my guess is, RBI sources tell me, another equal amount has come in. So why would you do a CRR cut when so much liquidity is being pushed in by the Reserve Bank simply by buying dollars? They don't want the rupee to appreciate. Therefore, my sense is that talking about cuts, repo or CRR, is extremely premature at this juncture.
All right, Lata, thank you very much for that. You know, by the way, the IIP data is for the month of March, right?
Yes.
We have lots of high-frequency data points for the month of April. I put out a piece on the 5th, which is the Friday before last, and I looked at, you mentioned electricity demand. So power demand for April, we have that. You know, the slowdown is there, but it's softened. It's lesser.
You know, the PMI data is what everyone is pinning on for improvement.
So manufacturing PMI is improved April over March. Services PMI is improved April over March.
No, let me tell you, services PMI is a 13-year high.
Yeah.
Composite PMI is a 13-year high. But wait, it has no connection with GDP. PMI is your mood. It is a yes or a no answer.
Correct.
It doesn't measure the intensity of the yes.
No,
so that is not well taken.
My only point is that this rate cut, I think that may be a little premature.
Yeah.
That's the point I'm making. That it's, the data is not looking despondent if you look at April.
Absolutely
the month of
well taken your data. Yeah. But you also in the editors roundtable, and I don't know, I think it was you said the earnings are not great.
Earnings are not
the March earnings. Yeah. So let us be very clear that growth is becoming a scare.
Of course.
And therefore, that is why these rate cut expectations are coming in, that inflation fear. But my sense is the RBI target is 4%. So at 4.7, they are not going to cut. And moreover, in May and June, inflation is expected to be higher, going back. That's why the RBI's average for April, May, June is 5.1. So we're going to get a higher number.
All right, Lata, thanks very much for that. This is a debate which on growth and inflation, which we can continue having, and we will continue having. It's an important one. Well, we'll take a very quick break here. Prakash Devan will be with us with some fundamental perspective. Lots of earnings came through, and we'll get Prakash's views on names like Tata Motors, etc. in a bit. Texmaco Rail reported numbers, the small company, but numbers were interesting. So we'll speak with the management. Hemant Bhuvania will be with us as well.
Welcome back. Let's kickstart our show with a lot of corporate voices now. It was a strong set of earnings that we got from Texmaco Rail Engineering for Q4. The EBITDA was higher on the operating leverage, and the steel, foundry and rail EPC business provided a boost to the EBITDA. The revenues and profits also saw a strong surge this time. Hemant Bhuvania, who's the CFO of the company, joins us now to talk more about that. Hemant, good morning and thanks for joining in. Can you outline for us what FY24 could look like in terms of growth? It was a good growth that you saw in the full year, so about a 38% growth on the top line. You're sitting on a base of almost 2,250 crores. What is the realistic growth that you're looking at in FY24?
Good morning and thanks for the invite. It's a pleasure to be on your channel. So for the March, for the financial year 23, we had in Q4 we did around 1,400 wagons, whereas in Q3 we were close to around 1,000 wagons. So there was a ramp up of around 40% during Q4 of the last financial year. From 1,400 onwards, we expect a further ramp up of around 25 to 30% in first half of the current financial year. And again, from in H2 of the current financial year, we expect another ramp up of around 25 to 30%. Railway being a buoyant market, we are getting inquiries from private sector too. So we expect that financial year 24 should be a good for entire wagon industry.
All right. Good morning, Hemant. Thanks so much for giving us those details in terms of production. I think you were hinting as well on a monthly basis, you're looking to get past that 500-600 wagons. So it appears you're pretty much on target. But give us a couple of more details in terms of revenues. How does this translate? Last year, I think you ended at around 2,250 crores. So for this year, what kind of a revenue number will be looking at? And also margins, they're still, in the mid-single digits, a little higher than that. What's the range we should work with for the coming year?
Absolutely. So we were around 3,200 wagons in the current financial year. So you expect a growth of around 30% from here, or 30 to 35% from here should be for the next financial year. Converting to numbers, on an average, one wagon costs around between 5 to 45 lakhs. So we can get the numbers from there. On EBITDA margin, you see the orders which we have got from railway, 20,000 plus wagons in last year, which we are executing currently. So it is at a very thin margin. So everything depends upon the number game. The higher the production you do, the better EBITDA goes. So it's totally on the number game.
Sorry, just to get the number, FY23 revenue growth was about 38%. What will the growth be in 24?
So you from here onwards, you expect another 30 to 35% growth.
That's on the volume number, sir, right? Or you're talking about the revenue number itself?
Or see, volume would be totally commensurate with the revenue. So your volume goes up, the revenue goes up as well.
Oh, so around 2,900 to around 3,000 crores is what we should look at.
Yeah, for our heavy engineering division. Again, we have our steel foundry and rail EPC division also. So there also, we were doing to the tune of 1,500 metric ton of railway castings last year, which in current year, we have achieved around 2,500 tons per month. And we expect a further ramp up of around 30 to 35% in foundry, with some minor capex and minor modification being done. So in foundry, again, you expect a growth of around 30 to 35% as well.
So your total order book currently, at the last number we have, is about 9,300 crores. Can you give us an updated order book figure, and what is the order visibility like across, your various segments?
Yeah, so current order book is somewhere around 9,000 crores, out of which we operate in three segments, that is heavy engineering, steel foundry, and our rail EPC division. So order book for heavy engineering is to the tune of 6,700 crores. For steel foundry, it is around 400 crores. For our EPC division, it is 1,500 crores, and the subsidiaries and joint venture is another 400 crores.
And any targets on the export front? I think earlier you had talked about a 500 to 600 crore number coming in from exports. Would you want to change that in any way? What's the visibility like?
Yeah, sure. So last year, we executed a gondola wagon export to Africa, and we had received a certificate of appreciation on the quality. So again, we expect a repeat order from them for around 300 to 400 wagons this year. I think the order should be materialized within next couple of weeks. And that would be executed in this financial year itself. On a steel foundry front, since most of the railway castings are being used captively by our heavy engineering division, so we have restricted the export to same levels. So foundry would again be at the tune of around 90 to 100 crores per annum.
All right. We could have chatted more. Thanks very much for joining us, though. Appreciate you joining in. So you're projecting a strong outlook for F524 as well after a strong FY23. There's no dearth of work in railways and allied sectors. I mean, there's, of course, the actual rolling stock, but there is also modernization of railway stations, etc. I mean, some have said, well, the work is there. The budgeted amounts, both in the fiscal sort of big union budget and how it trickles down, is massive. But is there capacity to build out at the same pace? Capacity, I mean, actual capacity, factory capacity, also people. So that's another longer discussion. For now, numbers and guidance looking pretty strong from Texmaco. We'll take a quick commercial break here. We'll be joined by Sudarshan and Mitesh on the other side. Prakash is with us as well. So we'll go across to them in a bit. Okay, welcome back. You're with us here on Bazaar Morning Call. There's 14 minutes to go for the pre-open session. Let's just quickly take a look at what the SGX is doing. It's improvement of some 25 points from, over the last 1 hour or so. It's still indicating a 40-point downtick at this point in time. Let's look at the rest of the Asian markets briefly and see what's happening. U.S. Wall Street handoff was soft. Dollar is looking a little on the upside, maybe breaking out a little bit. Hang Seng is on your screen. You've got the Taiwanese market, which is down as well. I mean, subdued, nothing very large. Anuj is here in the studios with a quick check on how things are looking. Anuj, morning.
Morning, Prashant, Sonia, Nigel. Well, very close to the all-time high, so nervous 90s. The bulls just don't need to bottle it up. Rest is fine. If you look at Nifty, mid-cap, bank Nifty, all are pretty close to all-time highs. And rest of the indices, whether it's auto, FMCG, capital goods, financial services, infra, they're already at all-time high. Stunning numbers from FIs over the last 10 days, 20,000 crores of buying, 2,000 crores a day of average. And the weekend numbers were very good, though almost all priced in, especially Tata Motors. But let's see, some nervousness may be due to Karnataka, but that should not be more than an irritant for the market. 18th May is going to be a very important day because expiry, and you have numbers from SBI and ITC. And the inflation numbers also is a very important cue for the market today, and that's also on the positive side. On the Nifty, I think the strategy remains the same. You have the two big support zones, 18,200 to 18,250 and then 18,100 to 18,200. That strategy worked on Friday. And resistance zone is 18,300 to 350 and 400 to 450. The bank Nifty is the one which has been the leader and has been, of course, buy on dips. An all-time high of 44,151, I think, will be the big resistance. If you take that out, then the path to 45,000 opens up. But let's see. There's a dip today. My sense is that gets bought today.
Okay, the dips get bought. Thanks a lot, Anuj, for joining in. So that is the trade setup. But let's get market expert Prakash Diwan into the discussion now to tell us how he's feeling about the markets. Prakash, hi, good morning. Anuj was briefly referring to stocks like Tata Motors that have reported good numbers, but the stock prices have also rallied a lot. What do you do at a time like this? Do you book profits? Do you buy afresh?
Good morning, Sonia. So I think Tata Motors, the performance was stellar, but probably difficult to continue every quarter. I mean, I've never seen these kind of margins in a long time for the commercial vehicle side. And interestingly, they're racing ahead to become that net debt-free, by the targeted timeline that they'd specified. So all of that is kind of, definitely a lot of positive tailwinds that are helping the stock. Autos as a whole, as a pack, has actually moved up. So I think Tata Motors, you could attribute the move thanks to, the run-up in the auto sector. But from here on, you'll probably see a little bit of a sideways movement till some time, till, this recovery in autos in the sales numbers, especially, the domestic numbers start kind of picking up. So if that happens, you'll probably see a leg up on the stock, but eventually it will definitely move to higher levels, is very clear. But you would have to, of course, wait for... the entire market seems to be a bit of it's run up too quickly. So I wouldn't be surprised if you see some sort of a softness come through. And that's the time to kind of add all these quality names to your portfolio. But don't lose sight of these stocks because they definitely need to be in the portfolio at some point in time. If not today, probably another 2-3 months later.
All right. Hi, Prakash. Good morning. Prakash, what about Avenue Supermarts? Now, that appears like a bit of a miss. Mangam was just telling us about that. How do you approach that stock?
So, good morning, Nigel. So, I think specifically on the stock, there will be more pressure. There's no doubt it's losing a little bit of ground, in terms of how some of the other retail businesses have shaped up, especially the ones that cater to a little bit of a higher price point segment. We've seen this this fall in Avenue. This could probably get aggravated. But what's more worrisome from these numbers is that when Avenue Supermart reports these kind of numbers, there is demand contraction that's live and kicking. I mean, you can't ignore it. You can't kind of, keep brushing it aside. It's very evident. And that same thing we've seen in some of the other numbers like Colgate-Palmolive. The rural spending is definitely something which is an indicator of how things are. And until the monsoon comes through, I don't see any change in that. So you probably have to wait for another grinding quarter of sorts, which is going to be tough on volumes, on volume growth, on numbers. So Avenue itself will, of course, pay the price for the softness. But they're the first to bounce back. So, when the turnaround happens, you'll probably see a very tactical up move that would happen. But till then, it'll probably be soft. I would watch the stock very closely for an entry at some point in time. But it is expensive. Let it kind of cool down. And then we'll probably see once the turning point is, the tipping point is very clear on the demand side.
All right. Stay with us, Prakash. We have Mitesh and Sudarshan also joining in with trading ideas. Gentlemen, good morning. Good to have both of you here. Sudarshan, you go first. How are things looking?
Yeah, good morning. See, we are in an uptrend. In an uptrend, we want to buy the dips. So far, even in the US on Friday, the S&P was down 45 points. That dip was bought. and eventually it ended up with a very small minor loss. That's the normal feature in bull markets, and we are in a bull market. Now, there is only one trade. Wait patiently for intraday dips and you'll get them and go long. There's something else. If once that 18,350 level is crossed and it's very close by, we eventually start going towards new highs. So at this point, don't even think of going short. Just be on the long side in the Nifty and the Bank Nifty both.
On the long side in the Nifty and the Bank Nifty. I guess that's some sane advice, given that we're not too far away from all-time highs, so perhaps it's just a matter of time before we get there. Mitesh Thakkar, good morning. Do you feel the same, that it's better to buy the dips or perhaps just be on the long side through the course of the week?
Good morning. Exactly. I think, this looks to be a phase wherein the indices could possibly go through a mild consolidation, but the broader trend, the overall direction remains on the upside. So one, decline should be bought, and I think, the position should be very clearly aggressively on the net long side. Tactically, you might want to keep changing the weightages, but I think overall, the directional bias remains on the upside. For me, the Nifty levels are 18,150 and then 18,050 on the downside. Ending closer to about 18,150 would be the first entry point with a stop below 18,050. And once 18,350 is crossed, as Sudarshan just mentioned, I think I would also look at a test of 18,500 to 600 zones.
What would your trades be, specific trades, Mitesh?
Yeah. Morning, Prashant. Today, for the day, I have a mix of buy and sell calls. On the buying side, as Aisha led with news that big breakout and gap up happened on Friday, I think it should see further upsides. Buy here with the stop at 35.90. Targets of 3,700 can be looked at. Delta Corp is a buy with the stop at 212.5 for targets of 230. And on the selling side is Bharat Forge. Keep the stop at 771. Look for targets of 730. And Federal Bank sell with the stop just above 128 for a target of around 120.
What about you, Sudarshan? What would your stock ideas be?
Well, it's also a mix of buys and sells. That doesn't mean we are not in a bull market. It just means that some stocks are now giving signs of exhaustion. Torrent Pharma is an intraday short with a stop above 60. Alchem has had 3 bad days. Some perhaps some company-specific problem, maybe. But now it's an intraday short, the stop above 35.08. A big boy HDFC had a big gap down. That gap down is now getting filled up slowly, and that happens, in strong uptrending markets, good quality stocks, when they gap down, fill it up eventually. So HDFC is a buy with a stop under 27.40, and Atul, which had another gap down and is now filled up that gap, is a buying opportunity with a stop under 6,800.
Okay, all right. Thanks a lot for that, gentlemen. We'll come back to you all for your calls later in the day as well. For the time being, let's get in Chandan Taparia, derivative and technical analyst at Motilal Oswal. Hi, Chandan. Good morning. What strategies you have for us?
Good morning, Nigel. Thanks for having me. So overall, the bias of the market is positive and every small decline is being bought. In previous week, we have seen the range between 18,050 to 18,020, 200. Last week, the range was 18,181 to 18,400. So range of the market is shifting higher, and we have noticed that every small decline is being bought. So I believe that till Nifty holds above 18,181, decline could be bought for the fresh target was 18,400, 18,442. Bank Nifty is comparatively more positive. It's just 200, 300 points away from its lifetime high of 44,151. Overall, we are witnessing some put writing and surge in the put call ratio, which clearly indicates that shift of higher base in the banking index. So we believe that 43,333 could act as a major support, and with this support, one can continue to be with buy on decline for the lifetime new high targets in Bank Nifty to us 44,151 and 44,500 level. Now talking about stock specific, as we have positive to range bound bias in Nifty, but more bullish on Bank Nifty, so selective banking stocks are likely to outperform. So in that name, we have buy on Axis Bank. This stock has given a decisive breakout above 888 zone after a long time. On weekly chart, we have seen consolidation breakout of last 14 weeks with some built up, and put writing is also visible. So looking for a fresh rally in Axis Bank with a stop loss of 888, and stock can head towards 955 level. Second trading idea, that is from the auto pick. We have positive view on the Nifty auto, and counter like Eicher Motor, Tata Motors, even Maruti are likely to perform well. So here we are recommending to buy on Tata Motor. Already the stock has seen good run up, but momentum could continue. So consolidation breakout of last 16 weeks, put writing, hold of higher zone, intact open interest on the long side clearly indicate this momentum could continue. So one can buy with a stop loss of 505. The stock can head towards 540 levels.
All right, Chandan, thanks a lot for joining in. That's Motilal Oswal with their views. Let's slip into a quick break. On the other side, we have the pre-opening rates. We will also have G. Shivakumar, who's the Executive Director and CFO at GE Shipping, to discuss the quarter gone by. Stay tuned.